This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. Welcome to Bazaar Morning Call. We're live from the CNBC-TV18 Motilal Oswal studio in Mumbai. I'm Sonia, and as always with me is Latha and Nigel. Thanks a lot for tuning in this morning. We wake up to mildly positive cues across the global markets. So the SGX Nifty is indicating a mild up move, and the US markets as well mildly in the green. But the investors are busy digesting the Fed minutes, which indicates that there could be higher rates ahead for some more time. A lot of the data that came through, and there's plenty coming through this week, the US job openings, the labor turnover report was quite strong, indicating that perhaps there are more rate hikes possible. But in our own markets, there was large selling that resumed once again from the FI community. So FI sold over 2,600 crores. There was a big gash in trade yesterday, and a lot of short positions opening up in key names, whether it's names like Infosys. There was long unwinding in banking names despite good numbers coming through. So Bank of Baroda, PNB, etc. seeing long unwinding. A couple of levels to watch on the index. Perhaps important to see if the Nifty holds on to the 23rd December lows, which was around 17,800. And the near-term resistance is around 18,300 to 18,600. Remember, the recent peak which we hit on 14 December was 18,660. So I'm watching out for this range, 18,000 to 18,300 or so. A lot of data coming through. There's the non-farm payroll, the hourly wages, the unemployment rate on Friday. So we'll be tracking all of that closely. Latha, Nigel, good morning. It looks like, yesterday we were speaking about this as to how the trend is more on the downside, and that seems to be the case.
Well, I'll have to see. Maybe today it could be different. Just to repeat what you said about the Fed minutes, there was unmistakable hawkishness. But for the markets, it was what they had expected. It was all more hawkish than what they thought. I was just wanting to put on the table this one sentence which seemed to indicate that they are worried about the unwarranted expectation of looseness in the market. The fact that if you looked at the CME Fed Watch tool, the Fed futures, they are still pricing in cuts. And that seems to worry the Fed officials, because they point out that our policies work only if they work through the financial markets. And the financial markets are pricing in something which we don't have in our mind, then we have a problem. They're clearly stating that. And, we will have experts to parse this thought process of the Fed. I'm just worried about that the market is going to price in cuts, then I have to indicate more hawkishness. That seems to be their worry, which perhaps they don't want to do, but the market is forcing their hand. The markets, of course, have risen because they were positioned for 2 days of fall after the US markets fell in the past 2 days. So we must not take away too much from the fact that the markets recovered. They may still digest something more in the days to come. For me, I think the bigger positive is the way the crude market has gone. I mean, at $78, it's a huge fall, and they are pricing in clearly a huge global recession. And, there'll be geopolitics, whereas Russia figure, we'll be less dependent on Russia if crude falls anyway. So this becomes very important for India. And the fact that the US yield market also did not react. So that also means the cost of capital is coming down. Both those are EM positive, India positive in particular. And I would agree with you that there is a big worry about the way the FPIs are selling. Look at the number. It's not just selling. It's 2,620 crores. And I was just counting going back from Feb 27th, every single day they have sold. When the market volume is low, they've sold 3 digits. When the market has resumed full activity, they're selling 4 digits.
You mean December 27th?
December 27th.
You said Feb 27th.
Sorry. Okay, from December 27th, they have been selling. And that, I think, is a bit worrying, that there is a relentlessness about the selling. And of course, as you pointed out, we will have to remain cautious till the payrolls. Otherwise, for me, the net today is actually positive, because I think crude overwhelms everything.
Okay, all right. The FIs, they have been bearish. Normally, market commentators, analysts, they'll try to hedge themselves, but the FIs haven't. There's only one way to put it. The data points that are coming in yesterday are bearish from the FIs, whether it's in the cash
so more
market
shorts,
or the FNO market. I'll explain that in just a bit. The question is, will they get stumped on the wrong side? Is there, in cricketing parlance, is there a dusra that's coming? Because they have gone all in yesterday on the short side. The Nifty is likely to open up in the green, but building on from there is going to be very, very important. Let's explain the FI and the cash market first. The institutional number, well, that's a net sell number. That's the FI and the DI number put it together, close to 1,900 crores. We haven't seen a sell number like this all the way since October. The FIs, in the last 9 sessions, they've sold 10,000 crores, 9,900 crores or thereabouts. What do they do in the F&O market? Well, the FIs, they added short positions. Close to 22,000 short positions is what they've added, with the short positioning now moving to around 64%. On the index option side as well, they bought puts and they wrote calls. And they wrote calls very, very aggressively yesterday. So let's pull up 3 strikes, the 18,100, 18,150 and the 18,200 call. These expire today. They've written, calls out there. The total is close to 2 crore shares odd. And because of such aggressive call writing, the PCR that was more than 1, it's come down to around 0.7 odd. Now, this is not such a bad thing. If we can hold on to the morning gains, you get an intraday dip and buy into, you will be forced to see a big short covering bounce that could play out in the near term. So the crucial levels, 17,900, why that's important? Because the 18,000 put has the highest open interest. Also at 17,900, you have the 100 DMA. So that becomes a very, very crucial line in the sand level, 17,900, 17,950. On the upside, in the last 2 sessions, they've gone to 18,250 and got rejected. So that becomes a very, very important resistance level as well. The SGX Nifty suggesting a bit of a green start. My guess is at some point of time, you'll get a bit of an intraday dip. And risk reward could favor you, provided we hold onto that 17,950 odd mark. It's weekly expiry as well, so volatility will pick up in the final hour of trade. So just keep an eye out on that mark. FIs bearish may not be such a bad thing. Will they get stuck on the wrong side?
Yeah, so if there is a bounce, then we get a very good bounce if there are so many shots. All right, we will of course discuss all this with guests, but therefore let me tell you what is lined up in the first half hour of the show today. First up, we will get you updates from the global markets, and Richard Harris of Port Shelter Investment Management and Robert Sorkin of Citi will be with us to discuss the global trade setup. Later, our research team will bring you CNBC-TV18's list of top 10 stocks that you should keep on your radar. And at around 8:30 a.m., we will do a fundamental stock analysis check with Nishchal Maheshwari of Centrum Broking.
Right. Well, there is definitely a risk-off sentiment on Dalal Street, something we've seen in the last few days, and foreign investors are back to selling in a big way. So let's get you some opinion on how to approach the markets today. On the equities front, Gautam Dugar of Motilal Oswal Financial expects a narrow, range-bound market till earnings season starts next week. He says they like financials, IT and consumer stocks. He says the near-term risk is the overall economic slowdown, as the RBI is projecting a 4.5% GDP growth in the second half of the fiscal, which is a fairly slow pace of growth. Other global challenges around higher rates, geopolitics and commodities could keep a lid on the market gains. However, they are not expecting any sharp fall unless we get ugly results this season.
Got that. Okay, now let's get your money market views. Parul Mittal of Standard Chartered says the dollar INR moved higher to hit the 83 threshold this week, while lower oil prices and central bank intervention capped the up move. She expects the dollar-rupee pair to trade in a range of 82.60 to 83.10 for this week. Adds that she expects the rupee to continue to underperform global peers in 2023 as trade deficit remains elevated.
Okay, and on the bonds, Parul Mittal Sinha says the domestic yields traded range-bound last week despite a downward correction in global yields. She expects the 10-year benchmark to trade in a range of 7.25 to 7.35% next week, with an eye on the December CPI. Also, the market's focus is primarily on the recent forex volatility and the FY24 budget on the 1st of February.
Okay, so those are all the domestic cues, and now let's